first Q&A session. My name is Mark Moss. I am the founding attorney for the law offices of Mark F. Moss, and I'm joined today with Linda Forde with the Forde firm, and we're going to be talking about taxes, tax implications as it relates to estate planning as this first quarter is coming to an end this year. Thought it would be a great time as everyone's kind of starting fresh, first quarter's finishing up, wanting to get their affairs in order. So first, Linda, welcome.
Thank you.
And if you can just tell everyone a little bit about yourself and the practice before we get started here.
Absolutely. So I'm Linda Forde from the Forde firm. We are a full service CPA firm. We service clients across all different industries, and we work with a lot of individual clients. We find that we collaborate very much with attorneys because of the specific nature of what attorneys like Mark do and what we do to make sure that the taxes are done correctly. And we pride ourselves on being that firm that answers the phone. In fact, we developed that as our tagline, kind of tongue in cheek and kind of not, that we answer the phone.
Love that. So before we get too far into it too, what sort of lawyer would I be? What sort of CPA would you be if we didn't have disclaimers and CYAs? So nothing today is to be construed as legal advice or tax advice. Listening to this today does not establish any attorney-client privilege. And to read all the full disclosures, just look below and you've got full text disclosures right there. And before we get started, again, because there's a crucial importance of getting everything correctly, pros and cons to everything in life, there's always trade-offs. We're going to use kind of the following facts for these questions and hypotheticals. So we're dealing with a married couple. It is their first marriage. They have 2 minor children, and their total net worth, including life insurance, is $3 million. So just to make sure everyone's on the same page with that. So generally speaking for this family, because there are minor children involved, I would recommend a revocable living trust. A lot of benefits to that. It's not for everyone in every situation, but there's a lot of benefits to that. So Linda, for you and from the tax perspective, what are the benefits and or impact, if you will, on the grantors or those that create the trust? What are the impacts to their taxes when the trust is set up?
There's not a huge impact to their taxes when the trust is set up, and because it would be revocable, it stays on the grantor's tax return, so it allows them to still have control over it from a tax perspective. They're still handling everything. It's going to be the growth down the road that's going to generate tax issues. They've already paid tax on the money they're using to fund the trust, and it allows them to have control over it. So that's such a great tool. I'm glad that that's what you would recommend for this scenario.
Absolutely. Yeah. And it's, like I said, it's not for everyone, but there are a lot of benefits to it. And I just want to clarify on one thing you said and make sure that I'm understanding it correctly. The growth on that principal or on the original amount in there, you said is taxable. But if you can just clarify when that would be taxable. Is it during their lifetime?
Well, it depends on how things are set up. So as a typical accountant, it depends.
I love it.
For most of them, it's not going to be during their lifetime because it's going to be in investments or in other items that aren't going to be sold or moved around. So there's not going to be a realized gain or a realized loss during their lifetime. They may sell some assets, they may make some changes to things, and there's some growth that has to be addressed. But the beauty of this is we're not paying trust taxes because we're not having a separate trust entity. And that's what makes it so valuable. So if there is something that happens growth-wise during their lifetime, we're not generating that extra taxing entity.
Gotcha. That makes a ton of sense. Excellent. So now that we've talked about the impact or lack thereof to the grantors or people that establish the trust, what about any taxable income to the beneficiaries, those 2 minor children in this hypothetical? How does having that trust, being a beneficiary, impact their tax planning or their taxes?
Well, it really helps to protect them, even from a tax standpoint. So obviously you're protecting them from the legal standpoint, but we're helping to isolate them and their specific tax situation from the trust. And we're saying, okay, there's growth in the trust. We're keeping this separate from them. We're not going to create a tax issue for them just because the stock market goes up, if that's what's within the trust, or just because the real estate market goes up. And we're not going to create tax issues for someone who may not be able to pay the taxes.
That's a huge, everyone's worried about the potential tax burden. But right now, as I tell them, first, I'm not a CPA. Talk to your CPA and your tax professional. But the limit right now for when estate taxes are applicable, I believe they're awfully high, that they don't impact a lot of people. Correct. Again, I'm not a tax professional, but correct me if I'm wrong.
No, that's correct. Right now, they're sky high. Well, I guess it depends on your perspective. Right? If you're a high net worth individual, it's not sky high.
Right.
If you are a so-called average person or middle class person, it's sky high, and you're not going to come anywhere close to having an issue with it. But there's other benefits surrounding it that allow you, as tax laws change, to not then impact your future self. So those limits are set to revert back to prior tax laws here in a couple of years, and they're going to be much lower unless the tax laws change. So you can't rely on what the tax law is today to be what the tax law is when the time comes for this trust to be executed on.
Absolutely. And that's where I'm going to, put a little plug there, where it's important to have that long-term relationship with your CPA, with your attorney, that as laws change and you're notified, then we may need to make changes in the future.
Exactly.
Excellent. We talked about the growth of a trust and the taxable effect or impact of that growth. What steps we've established that during the grantor's lifetime, there really aren't any different tax implications on them.
Right.
What are the tax implications on the beneficiaries of those trust assets, and what can they do potentially to minimize or reduce those?
Oh, that's a great question. So there's multiple things they could run into with it. And this is where the planning part really comes into it, as they start to come of age, and or as the trust looks like it's going to become theirs, they're going to truly be the active beneficiary of it. It might involve some charitable planning. It might involve donor advised funds, grouping of charitable donations. There are a lot of strategies around that. Now, the IRS has come out with a list of schemes or abusive tax trusts and tax evasion schemes. So it's really critical to work with a reputable attorney like yourself, because you don't want someone to set up some really crazy scheme that is going to get you into tax trouble, or worse yet, get your kids into tax trouble down the road.
Yeah, I cannot stress that enough. I've even seen recently someone touting that if you have a revocable living trust, you avoid paying taxes. Again, I'm not a tax professional. Do you know anyone that has successfully avoided paying taxes?
No. And in fact, that's where the IRS draws that line. They call it a tax avoidance or tax evasion scheme. So it would be a scheme, and it would be absolutely subject to penalties, interest, and potential fraud charges. So
that's what I thought. I just wanted to confirm with an expert that was accurate.
It is accurate. Death and taxes.
And then, excuse me, you mentioned donor advised funds, charitable giving. For those that may not be familiar with donor advised funds, or I often refer to them as a DAF, DAF, just an easy acronym, how can those be used as a complement to estate planning? What are some of the benefits tax-wise to using a DAF?
So for an everyday tax planning tool, it's great because you can bunch your contributions up by using that DAF, and they're 100% taxable in that year if they're cash donations. I mean, there's some caveats there, some typical accountant legalese, I guess, to go with it. But if it's a cash donation, it's a deductible 100% up to your AGI in that year. And those funds then can be trickled out to the nonprofit over multiple years. And it gives you that tax advantage. So the standard deduction's through the roof now. It's super, super high. A lot of people can't itemize anymore because that's so high. So bunching or using a DAF allows them to pick a year when they know they're going to have other itemizable deductions to go ahead and make that deduction and itemize. And then for wealthier individuals, it's a great way to make an impact in the community and make an impact in the lives around them with those donations, and have them planned out and managed strategically instead of just giving all the money to Charity ABC, and Charity ABC maybe can't handle those kind of funds on their own. They need a little support.
Right. That makes total sense. And so with the money that goes into the DAF, you had mentioned that it's tax deductible. Up 100% of that's tax deductible up to their AGI.
Yes.
So then is that more, and again, I know it's subjective, but looking at, I know we're talking about this hypothetical of the married couple, 2 children, total assets, net worth of $3 million. Is it potentially more tax advantageous to them and their estate to use a DAF or include charitable giving as part of a trust?
For many people, it's better you can include it as part of a trust. And the reason to do that is just the timing and how that works out. And if you're going to give a large amount, so that $3 million net worth, maybe they've decided that they want their children to work and they don't want them to have recurring trust payments, and they're going to give the whole $3 million to charity. Well, they're not going to have $3 million in AGI every year. So while they can carry it forward, tax laws change, better to protect it. So the trust method really allows them to protect it in a legal structure that keeps the tax law from affecting them too much.
Okay, excellent. And then how can a CPA and an estate attorney like you, like me, work together to provide comprehensive, effective planning that also minimizes taxes, maximizes benefits for the beneficiaries?
Well, I think that's the key, really, Mark, is that we get together on the front end with the client and we start talking about what their goals are, what their dreams are, how they want things to be handled. Do they want the kids to have a trust fund, what everybody calls a trust fund, and have HIMSS payments? Or do they want them to work? Do they want them to have money in a specific fashion as they age or meet certain milestones? And then talk about the tax consequences of each as we go, because nobody wants to leave their kids bills and nobody wants to leave their kids a tax problem. So we need to sit down on the front end and talk through those. You know, I know enough about trusts and estate planning to understand where things are going, but you're the expert in it. And like you said, you're not a CPA, you don't do the tax work. You have the knowledge, but that's where we work hand in hand, and it just makes it a better experience for everyone in the process.
Yeah, well, I appreciate that. I don't know if I have the knowledge, but I pretend to at least. That's where I'm going to rely on you, just like everyone else should. Well, I appreciate you joining us and helping answer some questions that we get often, and I think you get as well.
It's my pleasure.
Thank you, everyone, for watching.